In 1670, the Dutch controlled half of Europe's entire shipping capacity. They owned the world's most sophisticated financial markets, dominated global trade routes from Asia to the Americas, and their per capita income was the highest on Earth. 60 years later, grass grew in Amsterdam's streets. Ports sat empty. The merchant bankers who'd financed empires fled to London, never to return. What happened wasn't military defeat or plague or famine. The Dutch made a choice, a seemingly rational economic decision that would destroy their empire from within. And here's what should terrify every American. The United States is making that exact same choice right now, following the Dutch playbook step by step, expecting different results. The mistake? They stopped making things and started making money from money instead. Let me show you how an empire commits economic suicide in slow motion. By the mid-1600s, the Dutch East India Company, the VOC, was the most powerful corporation in history. They printed their own money, maintained their own army, and negotiated treaties as if they were a sovereign nation. Dutch shipyards built vessels faster and cheaper than anyone else. Their merchants transported grain from Poland, spices from Indonesia, silver from Japan. Amsterdam's stock exchange, established in 1602, created the world's first modern financial market. Everything seemed perfect. Profits rolled in, wealth accumulated, and that's precisely when the rot began. Because when you're making spectacular returns on financial investments, why bother with the messy business of actually producing things? Dutch merchants discovered they could earn higher profits lending money, trading securities, and speculating on asset prices than they could building ships or manufacturing goods. The logic seemed ironclad. Let others do the hard work of production while we collect interest and dividends. After all, financial activities required fewer workers, less physical infrastructure, and generated bigger margins. On paper, it looked like economic genius. In reality, it was the beginning of the end. By the early 1700s, the pattern was unmistakable. Dutch industrial capacity withered. Shipbuilding, once the crown jewel of Dutch innovation, declined as investors redirected capital toward financial speculation rather than productive enterprises. The VOC itself exemplified the problem. Instead of reinvesting profits into better ships, new technologies, or competitive advantages, the company embarked on what historians call profitless growth. They expanded operations massively, but that growth generated zero actual profit because it was financed through debt and speculation rather than productive investment. The company's debt spiraled. Corruption flourished. By the 1770s, the VOC was bankrupt, and in 1799, it dissolved entirely. Meanwhile, Britain and France were doing something the Dutch had abandoned, investing in productive capacity. They built factories, they developed new manufacturing processes, they poured money into research and industrial infrastructure. When the Fourth Anglo-Dutch War erupted in 1780, it exposed the hollowness of Dutch financial power. The Bank of Amsterdam, which had been making speculative anticipatory loans to the failing VOC, nearly collapsed. The liquidity crisis that followed destroyed what remained of Dutch economic dominance. Amsterdam's role as Europe's financial center vanished overnight, transferred to London, where it would remain for the next 2 centuries. The Dutch had learned a devastating lesson. You cannot sustain a great economy purely through financial engineering. Finance serves a vital function when it directs capital toward productive uses, building businesses, funding innovation, creating jobs that generate real wealth rather than just moving existing wealth around. And when a nation prioritizes moving money over making things, it begins a slide toward irrelevance that looks gradual until it becomes catastrophic. Now let's talk about America in 2025. The parallels aren't subtle. They're identical. In the mid-20th century, manufacturing generated 40% of all corporate profits in America and employed 29% of the workforce. Today, the financial sector generates 40% of corporate profits while employing just 5% of workers. Think about what that means. A low-employment industry replaced a high-employment industry at the center of the American economy. Finance went from 10% of GDP in 1950 to 22% by 2020. Meanwhile, actual productive investment, the kind that builds factories, develops new technologies, creates sustainable jobs, has been declining since the mid-1960s. This didn't happen by accident. It happened because of deliberate policy choices starting in the 1980s. Financial deregulation removed the constraints that had kept speculative activity in check since the Great Depression. Banks that used to fund manufacturing and R&D became masters demanding short-term profits. Wall Street's new mantra of shareholder value forced corporations to abandon long-term strategic thinking in favor of quarterly earnings beats. Companies that once reinvested profits into growth now disgorge cash to shareholders through stock buybacks. $1 trillion worth in 2017 alone, funded largely by tax cuts that's supposed to boost productive investment. The transformation goes deeper than numbers. American corporations increasingly behave like Dutch merchants in the 1700s. They've discovered that financial activities generate higher returns than making actual products. Why invest in a new factory that might take years to become profitable when you can earn immediate returns through financial engineering? Corporations shifted from producing goods to trading securities, from long-term value creation to short-term profit extraction. And just like the Dutch, this looks profitable right up until the moment it becomes catastrophic. The human costs mirror the Dutch experience with eerie precision. In 1982, when unemployment was near 10%, only 12% of workers worried about being laid off. By 2005, with unemployment at just 5%, 35% of workers lived in constant fear of job loss. Why? Because financialization destroys employment security. When companies prioritize financial returns over productive capacity, workers become disposable cost centers rather than valued assets. Pensions shifted from defined benefits to market-dependent 401ks, transferring risk from corporations to employees. Real wages stagnated even as corporate profits soared, because finance enriches shareholders and executives while diminishing labor's share of value. The intellectual capital drain is perhaps most damaging. Nobel Prize-winning economist James Tobin warned in 1984 about the casino aspect of financial markets and lamented that we are throwing more and more of our resources, including the cream of our youth, into financial activities removed from production of goods and services. He was right. America's brightest minds now compete for jobs, moving money around rather than solving engineering problems or developing new technologies. The average compensation in the financial sector exceeds $100,000 compared to $20,000 in 1980, drawing talented people away from productive industries. We're depleting our human capital exactly when we need it most. The debt parallels are especially disturbing. The Dutch Empire collapsed when accumulated debt, incurred to finance speculative activities rather than productive investment, became unsustainable. America's current debt accumulation follows the same pattern. Super low interest rates have encouraged debt bubbles in oil fracking, student loans, corporate bonds, private equity, and stock buybacks. Financial institutions make money from debt creation, regardless of whether that debt funds anything productive. The World Bank found that countries whose debt to GDP exceeds 77% experience significant growth slowdowns. America crossed that threshold years ago and keeps climbing. Here's what makes this genuinely terrifying. The Dutch Empire's decline took decades to become obvious, and by then it was irreversible. Each decision seemed rational in isolation. Redirect some capital from shipbuilding to finance? Makes sense, better returns. Let manufacturing decline while finance grows? Logical, that's where the profits are. Allow debt to accumulate to fund expansion? Prudent, everyone's doing it. But compound those decisions over years, and you wake up one day to discover your economic foundation has disappeared. The skills are gone, the infrastructure is obsolete, the productive capacity has moved elsewhere, and no amount of financial engineering can recreate what you've lost. The United States still has advantages the Dutch never possessed. We're larger, more diverse, technologically sophisticated, and the dollar remains the reserve currency. But those advantages are wasting assets. China invests heavily in manufacturing, infrastructure, and technological development. They're building productive capacity while America perfects financial speculation. And the same pattern that allowed Germany to surpass Britain is repeating as China challenges American economic supremacy. And just like the Dutch couldn't reverse their decline once the productive base had eroded, America may find that restoration becomes mathematically impossible past a certain point.
The solution exists, but requires political courage nobody's shown. Finance needs to return to its proper role, servant, not master. That means regulations ensuring capital flows toward productive investment rather than speculation. It means tax policies that reward long-term value creation over short-term extraction. It means corporate governance reforms that give management breathing room to build sustainable businesses rather than satisfying quarterly earnings demands. Most critically, it means reorienting the entire economy away from financialization and back toward production. Making things, building infrastructure, developing technology, creating jobs that generate real wealth rather than just moving existing wealth around. But here's the trap. Every actor in the system faces incentives to continue the current path. Financial executives earn fortunes from speculation. Corporate leaders get rich from stock buybacks. Politicians receive campaign contributions from Wall Street. Economists trained in efficient market theory insist everything's fine. Nobody wants to be the person who admits the emperor has no clothes, who says that American economic dominance rests on financial engineering rather than productive capacity. So the system perpetuates itself, gathering momentum, moving faster toward the cliff. The Dutch Empire's fatal mistake wasn't that they became wealthy, it was that they mistook financial wealth for productive capacity, speculation for creation, moving money for making value. They assumed finance could sustain an economy indefinitely without the messy business of actually producing things. They were catastrophically wrong. And now America, with perfect historical vision of how this story ends, is following the same script, making the same choices, expecting somehow that this time will be different. It won't be. Economic gravity doesn't care about exceptionalism. The only question is whether we'll wake up before the point of no return, or whether future historians will wonder why America ignored such an obvious warning, written in the ruins of Amsterdam's empty ports.